Fabrice Grinda is one of the most successful investors of our time. He did 1,100 plus investments, mostly in marketplace businesses and businesses with network effects. He was awarded the #1 angel investor in the world by Forbes. He sold a few companies as a founder, and he's quite extreme about sports as well. So I talked to Fabrice about his definition of success, how he approaches life, because he outsources a lot of his life to focus on the stuff that he really wants to do and loves to do. And I think that's very inspiring. We talked, of course, about his investment philosophy, hypotheses, how he builds his fund, and what he wants to achieve in the next years with his fund and why he wants to. And we talked about macroeconomics and what this means for you as a founder. And therefore, without further ado, welcome to a new episode of the Unicorn Bakery. My name is Fabian Tausch, and here is Fabrice Grinda. Fabrice, welcome to the Unicorn Bakery.
Thank you for having me.
At one point in life, I read and heard another podcast, you gave away all your possessions to charity, I think besides financial possessions, and you lived from 50 goods that you still owned and that fit in your suitcases and the backpack. So and you exited a company back then, or two companies, I think. So you were by all means successful, but what does success look like for you specifically? What is a successful life for you?
So let me answer this question two different ways. What does success look like writ large? So to be a successful life is one where I find meaning, purpose, and joy in every moment of my life. And the reason I'd given up my personal possessions back then is I felt that my friendships were fraying. As you get older in your 20s and 30s, people get married, they have kids. You don't see your friends or family in as deep, meaningful ways you did before. And I felt, you know what? If I give everything away and I start with a blank slate, and I can ask myself at any point in time, where do I want to be? Who do I want to meet? What do I want to do? I can actually reinvest in my personal relationships and friendships and my family. And so a successful life to me is one where I have meaningful connections with friends and family, where I'm a great parent. I'm now a father to a 2.5-year-old and to a 1-month-old, where I have an extraordinary life from an adventure perspective, where I'm like kite surfing, heli skiing, playing tennis or padel competitively, and stay very healthy, and am intellectually challenged and stimulated and professionally challenged. And last but not least, find purpose in things I do, right? Like the reason I'm an investor, the reason I'm an entrepreneur is the world is facing fundamental problems. We're facing climate change, inequality of opportunity, the mental and physical well-being crisis, and I want to be in a position to make a difference in rising up to the challenges of the 21st century. And I'm convinced we're going to solve them, and it's going to take tech founders and investors to basically do so. And so a successful life is one that has all of that. Purpose professionally, in terms of like finding and doing things that are meaningful for the world and making the world a better place. And I mean it non-ironically. I think the Silicon Valley show has confirmed that saying. And having a personal life that is rich of experiences, relationships, in every way, shape, or form.
So I think before I think I'm not the person to put things in perspective here, but like, what role does money play in your life then? Because you have been financially rewarded for the companies you built, for the investing you did, and so you're also called, you don't know, worldwide, like globally.
Frankly, it's a means to an end. It's a money buys you freedom, and it's a tool for actually getting the things you want. And in this case, the things I want is actually making difference in the world, which means investing in companies and building companies, which requires financial resources, and then having a great quality of life. So I'd like actually bringing my entire family together for Christmas. I fly them from France. I had 50 people over last year. I mean, it takes a fair amount of money to, not everyone has been as privileged as I am, and I'd like sharing that privilege with the people around me. And so I like to be generous, and money is a tool or a means to that end. But in itself, it's not a purpose, right? It's purely a tool.
You also recently published an episode on how you use your money to make your life easier and how you outsource a lot of things. And I think for a lot of founders and I think everybody who thinks about that, like, what do I really want to spend my time with? Outsourcing can be very interesting, and I found it very useful to listen to your perspective on it. So how do you decide what things in life you outsource versus what you do yourself?
Yeah, so my scarcest resource is my time, right? Like the one thing that's not scalable is my time. And so frankly, it goes back to first principles. What is it that I love doing? And I want to be spending my time doing the things I love doing. I love meeting extraordinary founders and listening to their stories and seeing if I can help them. I like thinking and reading and writing about tech. I like spending time with my friends and family. I like playing paddle. I like kite surfing. I like hosting intellectual salons. I like playing video games. I like spending time with my kids. And so everything else I try to outsource. And again, the money is a tool to that end, but that you can outsource more in life than you think. I think is one of the lessons, right? Like I have a virtual assistant in the Philippines that really helps me with everything from calendar management to bill payments to managing invitations for parties to, I mean, you name it, I outsource it. And I used to do it for my online dating where like the swiping was outsourced. I mean, like more things than you think can be outsourced. And I do the same thing in my offline life where I have a chef, butler, estate manager to help with the offline affairs. Now, if you like cooking, by all means cook. In my case, it's not doesn't provide me value, joy, and so I'd rather allocate the time to something else. And so the answer to the question is, do what you love to do, and it doesn't matter what that is, right? As I said, I love playing video games. Is it productive? No. But it brings me joy, and that's all that matters.
Does it sometimes feel overwhelming because you have then a lot of people that you somehow need to manage to make your life work?
Not really, because I've created a process where I don't need to manage them, right? Like my virtual assistant in the Philippines, Rose, she knows exactly what she needs to do every day. In terms of like, she knows when my agenda, when I have openings in agenda, how to fill it up. I don't actually manage my chef. He knows what I like and he makes it. I don't actually ask for any specific meals. So there's basically minimal management once you have the processes in place. And so it doesn't feel like extra work. It actually feels like it is freeing me a lot of time.
So what's your recipe for successful delegation?
So know what you want to delegate and create a process for it. So when I started, let me start as a founder. Like when you start as a founder, you're everything. You're the janitor, you're the customer service representative, you're the front end developer, the back end developer. It depends on your skill set, on your product manager. And so typically when I start a company, I do everything. And I do everything because I want to understand what are the issues that customers are facing. So I want to be the customer service representative. I want to understand. I mean, in the early days, you want to absolutely delight your first 100 customers. You want to like give them the best experience they've ever had, the most personalized service, and you want to make sure that you really understand what the product market fit is, what the needs are, and you want to address it. And so I like doing it, and then I understand what the issues are to A, make me a better product manager and make better product decisions, but B, also then when I hire someone to manage customer care, I understand the skill set they need to have, the issues that they're facing, and the processes you put in place. So when I'm doing it for my personal life, or actually professional and personal life, so my virtual assistant, for instance, we have a process where every day she sends me a control panel of what she did during the day with all the tasks, which ones are done, which ones are pending, and then the agenda for tomorrow, including the context for each of these. And so once that is set up, I don't need to be involved in it other than read the daily control panel summary of what happened. And so think through what the task is and how involved you want to be in it, and ideally structure it in a way that you're as least involved as possible. You want to do, hire people that are better than you at pretty much everything, and just do the things you have a superpower in, and that you love doing.
From a personal interest, like, does she then just send you a WhatsApp or an email, or do you use specific tools to monitor that?
Yeah, she sends me an email daily with the summary of the day, but we chat on WhatsApp during the day. If I have specific requests, or I have a question like, hey, when did I meet this person, and what context, what did we talk about? I mean, that would be for something already not covered in the daily email. Or if I have any requests, it's like, I forgot to do a doctor's appointment, trying to find a free time and schedule it. Or, I want to buy this on Amazon. Here's the link, just go buy it. And you were like, wait a minute, but buying something on Amazon, it's like a couple of clicks. It doesn't take that much time. Yes, that's true, but just giving someone a link is actually in WhatsApp is faster than doing anything else. And so I really try to minimize all these administrative, admin type of interactions and focus on things that make the most sense to me.
When I'm currently a founder listening to this and I hear how you optimize your life, and I'm currently building my startup, I have two things to think about. One, how can I use delegation and outsourcing and I think hiring in general in my venture, but also in my personal life. Should I focus on my personal life first or on my venture to figure out what to start with?
Well, the reality is it's the same person for both. I have a virtual assistant in the Philippines that I hired on yourremoteassistant.com, and it costs $1,500 a month full time. And they work at your hours. So if you're in Europe, they'll work at European hours. If you're in the US, they work at US hours, EST, PST, whatever. And so it is the highest leverage hiring you can do. But in general, I hire a lot of people on Upwork and the like, right? I make a photo album every year, and I have someone in Bangladesh helping me make it that I found on Upwork. I do video editing of different things. I mean, I'm pretty good at video editor myself, but for more advanced ones, I hire a bunch of people on Upwork as well. So I outsource as much as I can, and there are a lot of things that are high time savings, low cost, right? Like a lot of the labor in Bangladesh is like $1 an hour, and in the Philippines, I don't know what the equivalent of $1,500 a month full time is, but a couple of dollars an hour probably. It's not that much.
Is the thing that you try to avoid mind share and being involved in too many things and stuff that you don't like, so that you can't think about the stuff that you really want to do?
So first of all, I would argue I'm probably already involved in too many things because my mind is curious, right? Like if you look at my life, I'm hosting intellectual salons. I'm playing 3 sports competitively. I'm an investor in 1,100 companies. It's a lot of companies, and it's because I'm being driven by my curiosity. If I like something, I just invest, and I don't have any rules on, I need to do that many investments, and this is the ideal portfolio construction. So probably I would say I'm busier and doing more things that I should from a personal, from a output maximization perspective. But again, I'm not trying to maximize output. I'm blogging, I'm podcasting, I'm doing all these things, and I'm doing many of them half-assed, right? Like I'm blogging once or twice a week, but I'm not a blogger. I'm not trying to build a newsletter audience. It's not my business. I just do it for fun. And so for me again, is like figure out the things you like to do those things, and get rid of everything else. Understanding that as a founder with limited financial resources, you have to eat glass. You have to do a lot of work. You have to work infinite hours, and that's okay. It's part of the job, and until you can replace yourself in that position because you can afford to, because your business model is running, because your unit economics are working. So it's a question of finding those things you can move on from little by little over time. And it didn't start that way. I started, my first company, I was 23. I was a big micromanager because I couldn't afford to let go financially, frankly, and I didn't have the management skills.
What were the most important management lessons that you made throughout your career that then helped you to become a more relaxed manager, I would say?
In tech, it's better to move quickly than it is to get the right answer. And so when you hire people, it's better to hire people that are more entrepreneurial or younger and are not, the issue with more experienced managers and that have worked in large companies, they typically want to find the correct answer because the cost of failure is high in large companies. In a startup, cost of failure is nothing. We tried something, it didn't work. We'll try something else tomorrow. Right? So iterate very quickly. And so once I realized that it's okay to fail, and in fact, you're going to fail constantly, that the path to success in a startup is infinite failure that leads to the success that you need to do. So basically, you throw spaghetti on the wall and you see what sticks. And very little sticks, but ultimately you don't need many things to stick. You just need enough of them that you get something that works. And so obviously pursue excellence, pursue getting better, but speed as value, and making mistakes is okay. And so once I realized that making mistakes are okay because you can recover from 99% of them, then it's fine. You become a much more relaxed manager, and of course keep hiring the very best people. And my current bias is for smart, ambitious, driven versus experience. Now there are categories where that doesn't apply, and that's not true. But on average, I'd say that's more. People can learn things and figure things out. So I don't box them into whatever their background is.
So in Germany, at least, most of the funds tell me and tell the founders hire as senior as possible instead of hire for smart, ambitious, etc. Why would you? Is that a European or a German problem? Is that like, how is it comparably in the US? And why don't you think that?
Well, define senior, right? Like, yeah, I mean, again, define senior. To me, imagine someone who's like 32 or 33, who's been a P&L manager at Uber, or Instacart, or Airbnb. To me, they're senior, right? Like, you don't need to go more senior than that. They probably have the right intersection of youth, hunger, ambition, and experience. Right, so I didn't mean necessarily 22-year-old at a college, but I also don't mean 50-year-olds, right? Like that, and the difference is, it depends also on the companies you're building. Some of the lessons on hiring, by the way, like you probably want to hire a CFO, and that could be a gray-haired person if you want, sooner rather than later, or like a VP of finance, and get your budgets and financial controls in order. People always do it later than they should. Because they feel it's expensive, et cetera, but it pays for itself. Beyond that, here's the wrinkles on that advice. Like when I look at the founders that we have, most of them are in the late 20s, early 30s. The exception, though, is in the B2B marketplaces we're building of late. You need to be changing behavior in existing industries, and that requires credibility in the industry. So actually, we're investors in a petrochemical company called Nodi, and I think the founder is in his 40s or 50s, and he worked in petrochemicals for 20 years, right? So there are categories where experience matters, but you probably want to marry that experience with young, ambitious, tech-talented individuals regardless anyway. But within a startup, depending on what you're building, my definition of senior would be probably different from that of others. If you've had a few jobs and your relevant position in a reasonably large startup, that's pretty senior.
I think the more often you talk to founders who actually hired like super senior, meaning like probably corporate or too large of a scale up and then too high of a position, they also say, hey, we often don't need these people because they don't function in our smaller structures. But at the same time, most of the VC, a lot of VCs, and I can't generalize here because that's like always, as always, it's not black and white, but try to evaluate. Interesting. So you,
look, there's a moment where you probably need them, right? Like, again, you cut off. So I think I heard the question, which is, VCs are pushing you to hire them sooner rather than later. And the reality is, I think unless you're a couple thousand employees, you don't need them. But that said, when you're at a couple thousand employees, you probably do need them, right? Like, what is the role I want to play in my startup? I want to be managing products. I want to be defining strategy. I want to do fundraising. All the nitty gritty day to day, I don't want to deal with. And so having a large, my last company grew to 11,000 employees. So having an amazing COO to manage operations at a scale of thousands of employees makes a lot of sense. And the processes you need to build for 10,000 employees or very, very different from the processes for 30 employees, which are different from 100 employees, which are different from 500, which are different from 1,000. And in fact, 1,000 and 5,000 and 10,000 probably look more alike than 20 and 100. And so there is a point in time where you warn those people, but again, don't do it too early.
So the numbers that you communicated around FJ Labs are like 39 to 40% IRR realized, not on paper. You did 1,100 plus investments, so you're doing sometimes a few hundred investments a year. You raised your third fund. How, or what is your specific investment strategy that creates such returns that are pretty much outstanding in the venture ecosystem?
Yeah, so these are the numbers. We've had 300 exits that are realized, and we've had that 39% in realized IRR on those exits over 25 years. You know what? The investment strategy is funny because I didn't build it top down. I wasn't like sitting down with a piece of paper and analyzing what is the ideal venture portfolio construction. It was literally. It started out of my angel investing strategy. So I describe myself as an accidental venture capitalist. I'm really an angel investor who turned into a VC, kind of. So first, let me answer the question. The strategy is angel investing at venture scale, where we behave like angel investors. We're investing in hundreds of companies every year. We write small checks like 350 to 500K. We don't lead, we don't price, we don't take board seats. We take 2 1-hour meetings over the course of 1 week, and we tell you yes, no, and why. And and we invest especially in network effect and marketplace businesses, pretty much in every category, in every geography, in every stage. But it's kind of 50% U.S. and Canada, 25% Western Europe, and the rest of the world. It's vast majority seed and A. Some pre-seed, some B onwards. Now, this strategy is a reflection of my personal curiosity, which I mentioned before. I like meeting founders. I like helping them if I can. If I meet founders I like that are solving interesting problems, I like to back them. And it just so happens, and when you look at the data, and AngelList has a few posts on this, a very diversified portfolio actually is the highest performing strategy over long periods of time, right? Over one fund, we're never going to be at the top because one fund with one deal that is the best deal gets all the returns. But over 20 years, if you're too concentrated, you probably don't get all the best deals. And so as a result, you don't do that well. In our diversified strategy, because venture follows a power law where the top few deals get all the returns, we guarantee that we are in these deals. And as a result, we end up doing well. Now, the reason I describe myself as an accidental angel or accidental VC is I started as an angel back in 98. So when I was founder of my first company, a lot of other people started approaching me to invest in, and I was a founder, not an investor. And I'm like, is it a distraction from my core mandate as a CEO to be an investor? And ultimately, I decided, you know what? If I can articulate lessons learned to others, it makes me a better investor. If I can keep my fingers on the pulse of the market in order to understand the trends, it makes me a better founder, not investor. And as a result, as long as it doesn't take too much time, so I'm going to create a process by which in 1 hour I decide if I invest or not. I'm going to decide quickly in categories I understand. So only marketplaces and artifact businesses, because that's what I'm building, in which case it's illegitimate. And so by 2013, when I sold my large, big venture-backed company, OLX, I'd made 173 investments, dozens of exits, was doing well. I'm like, okay, with my partner, we built FJ Labs, kind of as a family office to build companies, invest in companies, didn't really think of turning it into a VC. But then a bunch of people wanted exposure to what we were doing, and I mean like strategics, family offices, wealthy individuals. And so we're like, okay, fine, we'll create a fund. But we're not changing our strategy. We're continuing to be angel investors. And so FJ Labs, we're angel investing at venture scale. We decide quickly, and it's been working really, really well. And it's a reflection also of our ambition, passion, curiosity.
You said also AngelList did the research, and I think you're at least one of the best, if not the best, living example on a distributed strategy, that it works and that it delivers amazing returns consistently. Why do so many funds out there use a concentrated strategy instead?
I think the reason funds use a concentrated strategy is that's what the limited partners, the investors in the funds, push them to. If you're a limited partner at a pension fund or a sovereign wealth or an endowment, you see yourself as the manager of the limited partner to be investing in 20 different VC funds. And each of them, you expect to have 20 investments. And so if you invest in 20 that have 20 investments, you have 400 deals and you have diversification. And so if you invested in FJ Labs, you're kind of already diversified. It kind of negates the job you should be doing, right? What's your role as a manager for that for that limited partner, for that wealthy individual? And so the LPs in general don't like distributed or strategies because they see their own role as getting diversification by investing in many VCs. And so ultimately the VCs, because the incentive systems in the category have a tendency to do what the LPs want them to, they're like, oh, I'm a Series A B2B SaaS investor in the US and maybe even in this vertical or this city or whatever. And they all specialize. But at the end of the day, of the capital deployed to date, I think my partner and I deployed 150 million. We're like the largest LPs in our own funds. And so it's a privilege to be in a position to do what we want to do and not to be driven by the demands of the market. And does it make it harder to get capital from LPs? Absolutely. There are many endowments, universities, et cetera, that have told me, no, we don't invest in diversified strategy. I'm not going to convince them that they're wrong, and they should. I think they totally should. And the data suggests that they would be better off investing with us, but whatever. That's their strategy. But yes, it makes it harder for us to raise capital, but that's fine. At the end of the day, I'm not trying to collect infinite assets under management. Having a fund kind of actually falls in my outsourcing strategy. The reason Jose and I started building a fund and having a team is we were getting too many deals. Every week we're getting 300 deals. And I want to be talking to the best founders. And so actually having a team, and we have 10 investors who are filtering the 300 deals, so we get to the top 5 per week, makes a lot of sense. And again, it's a amazing quality of life. And as we got bigger, the number of legal things that started happening, exits, IPOs, down rounds, up rounds, going public, going bankrupt, whatever, kept increasing. And so actually having a back office team, we have a huge back office team to deal with all that, made a lot of sense. And so that's the benefit of actually having a fund, is you can have a team to deal with the things I don't like. Now, the downside, of course, is we need to be raising money from LPs. We need to be providing reporting. But, that's why we have 4 partners on the fund, and we allocate or divide labor intelligently. It's my partner, Jose, and Jeff that do most of the fundraising. And we have an investor relations person. And then we have a big back office team with COO, CFO, and everything that'll help with the back office. This way I can focus on thinking about the future and trends and thesis and meeting amazing founders and building new companies.
I think I read that you, in my opinion, only have 20 LPs to get to the target, to the fund size that you are at the moment. This sounds like a relatively low number of LPs and a high number, like a high commitment per LP, which I think was very interesting, because from when I talked to other funds, I think they have a more diversified LP base.
So Fund 2 was 175 million, 20 LPs. Fund 3 is 290 million, about maybe 50 LPs. And I think it's intentionally, we put high minimums of 4 million because we'd rather have more meaningful conversations with a few LPs than an infinite LP events. Partly because also our time is limited, right? Every LP expects us to talk to them maybe once a year. I need to go pitch them. If I have 1,000 LPs, I need to pitch 1,000 people. That's 1,000 hours a year that I'm not spending time on meeting founders and thinking about the future and doing things that I think are actually my real job. And so I would rather have a reasonably not too concentrated, but 50 LPs than 1,000 LPs, and I'd rather have convictions checks as well. And given that many people don't like the diversified strategy, it also helps, right? Like if someone tells us they're not into the diversified strategy, I'm not going to spend 1 minute trying to change their minds. They're wrong, by the way, but I'm not changing their mind. So it's not worth my time to go and take a meeting.
Additionally to the self-selection of, hey, do they like our strategy of investing or not? What requirements do you have for LPs?
I don't really have requirements other than they be aligned with our values and mission, right? Like at the end of the day, the reason I'm a VC is because I want to use technology and its deflationary power and its ability to improve user experiences to solve the world's problems. And I'd like them to believe and buy in our mission, and if they can write pro rata check, or they can write co-investment checks in their best deals, that helps us as well because we don't have enough capital to do that. If they can be around for the next few funds, that's actually a big plus for us. So it makes fundraising easier. But yeah, that's basically it. Aligned values, people that believe in us and support us and are around for the long run.
So you said you get 300 deals a week. That's like 15,000 deals a year. If we talk about 50 weeks in a year.
Yes.
I can imagine that not all of them are marketplaces, etc. But even in network effect businesses, even when those are the ones that you are committed to, what needs to happen that you do or make an exception and invest something that's not a marketplace or a network effects business?
So we have a number of cases where we have exceptions. The easiest case for the exception is if the founder is one we backed before and they've done really, really well, and now they're coming back to their new company. And it doesn't matter what they're building, they're going to get a check from us. And that's how we ended up investing in a electric flying taxi company called Archer, a VTOL company. And we ended up investing in a robotics company called Figure. The founder had built a company called Weiterhin, which was a labor marketplace. We sold it to Adecco for like $100 million. We'd done very well. And then we backed him in Archer. And then he sold that. We did very well. And now we're backing him in Figure, which is early, but looks extraordinarily promising. And so that's the number one rule. If you're an amazing founder, we backed you before, you did well, we will back you, no questions asked, no matter what you do. And that leads to actually a lot of investments that are non-traditional, because to date, in the 1,100 companies, about 2,000 founders, 300 exits is about 600 founders. We've made money on half of these, so it's 300 founders that essentially kind of a blank check. Whatever they do next, they're going to get a check for what they do. So it's a fair amount of founders, and it's an increasing number as well. So it's an increasing number of checks and repeat founders doing things that are not necessarily marketplaces. Case number two, it's businesses that are marketplace adjacent or infrastructure to support marketplaces, right? So we're investors in Rapid or Stripe, which are like payment companies that by all our marketplaces use them. We're investors in ShipBob, which is a last mile picking and packing warehouse business that most of our marketplaces use. And so things that are supporting the underlying businesses. So the infrastructure layer, Flexport, I mean, it kind of is the marketplace itself, but it's a digital freight forwarder. And again, it supports the B2B digitization and global trade, and it supports a lot of our underlying businesses. The next category is a lot of businesses that are not currently marketplaces, but could really become marketplaces, right? So there are a lot of B2B SaaS companies that are currently just a B2B SaaS, but could become a marketplace, or vice versa, marketplaces that could be SaaS enabled. And so and the reality is you find network effects in more places than you think, right? And marketplaces, to me, is a broad definition. And let me give you my definition. It's a company that is an intermediary between a provider of something and a seller of something. And so let me give you an example of a fintech, a company that is doing factoring. Well, to me, it's a marketplace because it's an intermediary between provider capital, typically the banks, and a borrower of capital. It could be a company or an individual, it doesn't matter. Now, you have a network effect business when, as you scale, your customer acquisition costs go down. your margin increases, and more of your traffic becomes organic. And so in the example of the prior fintech, as you scale, typically more and more capital providers want to provide you capital, your cost of capital goes down, and then your data improves such that your metrics for underwriting get better, and often you're in a position as a result to offer better rates, and you end up in a position where your CACs start declining over time. And so these things, and even though many people put this in fintech, the dynamics with network effects and marketplacey. And so granted, it's a broad definition, but it gives you a sense of what that means. Now, obviously, the things that are not included in here are hardware, biotech, but many categories that used to be not network effectsy and not marketplacey are becoming that because of software. So think of climate technology. It used to be climate technology. You were building whatever, a fusion reactor or maybe a massive solar plant, and you needed $100 million to turn the lights on. Obviously, that's not the type of things we invest. But in the climate space now, we have carbon offset marketplaces. You have grid management software, which is actually managing a marketplace, right? Like, so a company like Leap is using people's cars that are connected to the grid as batteries for the grid as a whole. So you're doing load balancing on the grid using people's at-home batteries and cars. I mean, these things have now marketplace dynamics, even though it's a piece of software that's essentially being sold to the utilities. And so more and more of the world is becoming software, right? Like the software is eating the world sentence. I think it's from Mark Andreessen. And as a result, more and more businesses are starting to have these marketplace and network effect dynamics.
What started to fascinate you about marketplaces? Because you are now following this model for so many years and decades. Why did you never? So on the one hand, you're like absolutely an expert in marketplaces, but at the same time, a lot of other people that I met then got broader in what they did and not like deeper and like even more into the same niche. Why did you stay in that niche?
So first of all, I'm an economist by formation. And as an economist, I always understood the value of markets for creating transparency and liquidity and things that are opaque and fragmented, and the massive amounts of value that were created. And turns out that niche, as you called it, is much larger than we think because it applies, so yes, we are specific on a type of business, but it's in every category, in every industry, right? We have marketplaces in the climate space. We have marketplaces in petrochemicals. We have marketplaces in most B2B industries. And so it is actually broader than it looks. It's just the dynamics of the business that are specific. And there is a concept of circle of competence. In life, you want to do the things you're really good at. And if you're very smart and very successful, there's a tendency to believe you're good at everything. Now, you could maybe become good at everything, but it doesn't make you good at everything by default. This is the way, like, doctors who are, amazing neurosurgeon thinks he's amazing at investing and loses all his money because, of course, he doesn't know anything about investing, but he thinks he does because he's smart. And so as long as the industry and the category I'm in remains very large, very attractive, there's no reason to go elsewhere, right? Like I could deploy $1 billion, maybe I could easily deploy $1 billion fund, like $300 million, $400 million a year without changing anything in my strategy. And I'm really, really far from that, right? Like I'm 3x away from that. And so for now, there's really no reason to change. And I love the marketplace dynamics where it's capital efficient, it's winner takes most, and it's massively deflationary. It brings tremendous efficiency. And when I look at the world, especially the B2B world, where today in every major vertical, and the B2B world is like most of GDP, right? Like petrochemicals is trillions, and metals, and steel, cement, all these things, which are like the fundamental inputs that build the world, are trillions and trillions and trillions of dollars. And online penetration is like sub 1%. At best, it's sub 5%. And so the idea to build marketplaces in all these industries and helping digitize all the businesses, which is our current thesis, we're at the very, very beginning. We're day one. We're maybe even day zero. Nothing has been done. Everything remains to be built, and this will happen over the next 20 years. And look, maybe one day these different theses are played out and we'll do something else. But right now, and for the last 25 years, I keep finding more and more places where this applies and more categories where it applies. So like even categories where it didn't apply before, like climate, where it's now you're starting to see opportunities in marketplaces in climate. And so I'm very bullish on the opportunity.
The most interesting thing about you is you always say you love the 0 to 1. At the same time, you're bringing FJ Labs to 1 to X, X being like, let's say 100, by bringing a lot of companies from 0 to 1 again. Like it's an interesting cycle that you built.
Yeah, look, I like the 0 to 1 personally, as in I'm building a company, it's fun, it's exciting, etc. And by the way, FJ Labs is a startup, right? There were 34 employees. We didn't exist a decade ago. I didn't join a fund. I created a fund. And so it feels like we're doing the 0 to 1 here as well. And yes, so hopefully it goes to 100, but not 100 employees. I'm hopefully definitely not that. Hopefully we're scalable and we can deploy more capital of the same team. So I like this beginning super new energy of building something from the first time, which is why, by the way, at FJ, we have a studio program where we help build companies. And actually, I recently helped build a yield-bearing stablecoin. It's a German company, actually, called Midas. And that 0 to 1 phase is super fun. And at some point, the team is fully formed and then it doesn't need me that much anymore, then I'm just on the board.
What needs to happen that you can deploy more capital with the same team? Because what you don't want is like inflated rounds where you would need to write bigger checks to get the same thing happen.
So right now we're very undersized. Because our fund size is, let's say 300 million, it's 290, but whatever, 300 million, we're deploying 100 million a year. And our current check sizes are 150K pre-seed, 300K seed, 500K A, and 550K B. Because if we wrote bigger checks, we would basically run out of money too quickly. And the LPs we have, they want to fund every 3 years, not more. But I could very easily write 250K pre-seed checks or 200K pre-seed checks and 450K seed checks and whatever, 900K A checks and $1.5 million B checks or even $2 million B checks without changing the team, without changing the strategy. So the only thing we do, we're not changing the valuation, we're not changing anything. The only thing we do is we write a bigger check in the exact same strategy. And I suspect we can do that with 300 million a year. Probably not more, by the way. So we could not be a $5 billion fund. So then I would need to change the strategy. And by the way, I don't want to change the strategy. So because I love the strategy we're pursuing, I like the way the number of founders I'm meeting, the number of deals we're doing. I don't want to change the strategy, but I would like to write slightly bigger checks. So yeah, if the next fund could be a $500 million fund and the fund after that, 750, then we reassess because it does depend on market conditions. I suspect your ideal fund size is probably around $1 billion, but it might be 750, it might be $1 billion too, but probably that range given the current environment. And we would not need maybe a few more people, but I don't think we need many more people to do that because it's the exact same strategy, just bigger check size. And hopefully we get there. TBD, right now we're raising a fund in today's environment is hard. LPs have been burned, they feel over allocated. Now the good news is we're not raising right now. Fund 4 for us will be in 2025. So we'll go to market in late 24, early 25 for a 2025 close.
Which sounds quite soon when we look at that it's already April 24. It's interesting how time flies. If I listen to that, it sounds like it's so far away, but it probably isn't. I think there is no person on earth that saw. I feel confident saying that. You can accept or decline, but that saw as many marketplace businesses as you did. So from all your experience, what would you say is the hardest part about bringing a marketplace to a successful company in a winner takes most market?
So in marketplaces, you're always facing the chicken and egg. And so you start with supply or demand, and then how do you match them? So getting to the point where you have actual liquidity and the network effects kick in is the hardest thing. Because in the early days, you don't have network effects. You're basically hacking one side or the other, etc. My recipe would be the following. And you start with the supply because the sellers are financially motivated to be on the platform. You curate the very best supply that you make sure that they're on the platform, they love it, etc. But you have very limited supply. Then you bring demand to that supply such that the sell-through rate, if it's an item, is like 25%. If it's labor, maybe you represent at least 25% of their earnings. And once you do that, then you scale the supply again. And you keep scaling them in parallel until the flywheel kicks in. The biggest mistake you can make, which is the most common mistake in marketplaces, is you get infinite supply to begin with. And then you don't have any demand for them. So they're not engaged, they churn, and the flywheel never kicks off. You know, if I wanted to build a locksmith marketplace in Berlin, I don't have any locksmith there in Berlin, but maybe 2,000 or 3,000. I can probably call every one of them in a month and convince them, because we're free, to be on the platform. But that doesn't mean, especially if I bring them 0 clients, that they would be active, engaged, would reply, and would provide a delightful experience for the users. But if I signed one in one neighborhood, and then I bring them a lot of customers and they're delighted and both sides are very happy, then I bring another one on. And if you can keep doing it like that, then you can build your successful business. And so getting to the point where you have actual liquidity, even at small scale, that the flywheel starts going, is the hardest thing to do. Especially, to your point, in winner takes most businesses, because what sometimes happens, less today, but definitely in 2021, is you have 8 competitors who raise a lot of money and all going after the same category. And so there's a temptation to go and use spending, either in sales team or marketing or whatever, or negative economics, in order to launch the flywheel. And often it backfires. And also, if you have too many people trying to do the same thing at the same time, you can destroy the entire economics of the business. I mean, we saw it in like the ride-sharing wars. You saw it in the scooter wars. You saw it in the classified wars around the world, where for a long time no one was making money because there's too many people subsidizing. Or you saw it also in the quick commerce business, the Getir, Joker, business, where there's so many players subsidizing delivery that everyone was losing money.
I know you're a math guy, and I assume you're a framework guy too. So is there an equation so that I can figure out my liquidity formula?
Yes, you have liquidity typically when 25% of the items listed sell. So if I list an item on a used good platform and the probability of it selling is 25% or more, that means you have liquidity. If you are a labor marketplace and people are listed on it, you represent 20% or so of their income, you have liquidity. On a classified business, if your retention after like a year or two, well, it's still going to be percentage of probability of items selling, but you could also look at it on like user retention after 12 months, and it should be at least 40-50%, right? Like, and you should have like in a classified platform, you should have at least half the users come in every month, essentially. So it's a combination of DAUs, MAUs, but ultimately liquidity is going to be driven by the probability of the item selling. And so it's really the way you look at it. It's really at the end of the day, it's like let's say you're selling items, number of items lists, number of visitors that are sellers, number of visitors, what percentage of them are sellers and lists versus times the number of items that actually ultimately end up selling times the AOV times your take rate. It's kind of like the way the business works, and you compare that to your CAC. And then you look at retention and over a 12-month. And I want unit economics where you're fully recouping your customer acquisition costs on a contribution margin 2 basis after 6 months, and where you're 3xing your CAC after 18 months on a CM2 basis. And if you're not there, I need to believe you're going to get there with scale without like every star in the multiverse aligning.
In the early days, or I think that's also true for scaling, can I have a too high probability of selling and turning over the items?
No. If the items sell and they sold super quickly, that's amazing. And if it means you need to get more items, great. Get more items. It'll be easy to convince people. If items sell so quickly, it'll be very easy to get other people to sell. So you can never be too high. If your sell-through rate is 100%, that's amazing. Probably suggest sellers should increase prices, but yes.
What's the dumbest thing to do when I reach liquidity for the first time?
The dumbest thing to do is overflow your marketplace with supply. So classified businesses, which are usually C2C, sometimes they're tempted to go, oh, let's go to B2C, let's get infinite items. But then these items are high price, low quality, and the sell-through rate goes to zero, and you destroy liquidity. Or in the example I gave earlier, you put infinite locksmith on the platform, but none of them are getting any buyers, and so as a result, they churn and they're not engaged. So you need to keep scaling little by little your supply and your demand such that you maintain liquidity. If you overwhelm your platform with like supply, all of a sudden you're going to destroy your liquidity.
And from a scaling perspective, at what stage would you want me to reach the network effects of me needing more people to reach a scaling benefit of my marketplace?
Yeah, probably after the Series B, right? Like, so with your seed round of $1 million, I expect you to get to maybe 100. It depends on the business, but let's say if you're a B2C with a 15% take rate, maybe for seed, from pre-seed to seed, I want you to go from 0 to $150K a month with a 15% take rate. So you're whatever, maybe you make 25, 30K a month in that. If you're B2B, maybe you're doing 500K a month and you're taking 5%. We get 25K a month. With that, you raise 3 at 10 pre. And with that 3 at 10 pre, I expect you to get to whatever, 750K a month with 15% take rate, whatever, 100K net, or maybe 2 million a month with a 5% take rate, and in B2B. And then with good unit economics, but you're still going to be losing money. Then with that, you raise your Series A, which is like whatever, 7 at 23 pre, 30 post, and you get to 2.5 million a month with a 15% take rate, or maybe 10 million with a 5% take rate, and or 7.5 million. And with that last round, like, it's not the last one, but I expect you to get to a scale where you're at 100 or 200 million in GMV. You could be profitable if you want to, and then you have the choice of like, do you raise more money in Series C, D, E to scale, or not? And so that's what I'm really expecting: proper network effects, scalability, et cetera, et cetera.
Let's say you invest in my seed round. What needs to happen that you invest, meaning follow on, in my Series A?
So you need to be at a place where you can raise a Series A. So if you were doing 150K at seed, you need to be doing whatever 600-700K at your A. The economics need to look good, meaning you need you need to have found a scalable customer acquisition channel. I don't care if it's sales team or marketing, or doesn't matter what it is, but it needs to be scalable and repeatable. Add good unit economics, and you need to convince me that maybe the amount you raise in the A, which is going to be whatever, 7 million, 10 million, you're going to be able to go to the next phase. And it's important, the price needs to be fair in light of traction. And if there are many cases where the team is amazing, the traction is amazing, the economics are good, but the price is too high, we won't invest. So it goes back to our 4 criteria. Do we like the team? Do we like the business? Do we like the deal terms? And do we like the thesis? And if all 4 are true, we do it. And that's true for first-time investments, but it's also true for follow-on investments.
So if the price is too high then, but everything is still fine, would you stick and hold all your shares, or would you do secondaries?
Well, you can... Private market, the secondaries are only or rarely possible in the A, almost never. If I feel that something is overvalued and there's a secondary opportunity, but usually would be in the C or the D or the E, I might sell 50%. I don't typically sell 100% because you never know. Sometimes trees grow to the moon, but also secondaries are almost never possible. You need to realize that it's only the very best companies where you can get secondaries.
For that statement to be true, you have definitely a high rate of exits compared to portfolio. So you definitely did a very good job in being in the best companies.
Well, I'm also a contrarian. So in 2021, when there's a lot of secondaries or more secondaries than normal that are possible, we chose to sell when we felt valuations were high. So he took it. But it's interesting because in 2021, everyone was like, we need to invest. The opportunity is huge. And we're like, these valuations are insane. It's 100x ARR or whatever. I don't see how we get there. Take money off the table. And it was the opposite last year. In 2023, everyone was like, oh my God, the world is ending. We're going to have a recession. We should not be investing. And last year I was like, no, it's the opposite. Valuation is reasonable, less competition. We should be investing like crazy. So on the macro side, you want to be a contrarian. But yes, because I've been an investor for so long, many of my companies have reached maturity where I can get secondaries, right? Like right now. So look, we're investors in things like SpaceX or Stripe or Flexport or ShipBob. I mean, these are all multi-billion-dollar companies. Klarna. There are secondary options out there. You may or may not want to take them because you may agree or disagree with the prices in the secondary markets. But if you're an investor in enough companies for a long enough time, many of them are going to reach the billion-plus valuation stage where you can start getting secondaries. But even then, there are many billion-dollar companies in the world that we're investors in that we cannot get secondaries in. But right now, for instance, we're not selling anything because many of these companies are doing very well. Like ShipBob is crushing it. And the prices that people are being pitched on secondary markets are like 50 or 60 or 70 or 80% discount to the last round. And when the company is doing really well, and I think there's a real path for them to double or triple in size and either grown or more than grown in their valuation or increase their valuation dramatically as the public markets open again in 25 and 26, it makes more sense to wait for the IPO.
How do you protect yourself against the fear of missing out during, let's say, the times where everybody wants to buy the secondaries and you then still sell them?
Look, everyone else has FOMO. I don't seem to suffer from FOMO very much. You need to realize most of my exits are secondaries, and most of the exits are selling to supposedly the smartest and best investors in the world. So most of my exits I'm selling to Sequoia and Greylock and Andreessen and back in the day, Tiger and SoftBank. Now it turns out that Tiger and SoftBank was not as smart as they thought they were, and that as the rest of the world thought they were. But that's okay. It's a question of what are you underwriting? I want to underwrite a 10x. And so if a company is only going to be a 3x from where it's at right now, doesn't necessarily make sense for me to continue to stay in because I want to be underwriting at 40% IRR. If I'm not underwriting 40% IRR and a 10x kind of potential, I'm better off selling, taking the capital and redeploying it in my seed rounds or A rounds where I'm more confident that I'm going to be able to get these types of returns. But if you have like whatever, it's 5-10 billion in your Sequoia, I think if they get 3x, especially the late stage, I think they're happy. But I'm not happy. Even late stage, I'm not happy with 3x. If I'm only going to underwrite a 3x, I'd rather not be invested.
That's so interesting because there's the saying that a lot of the value in a company is captured like in the later stage, for example, even after the IPO. And that's something why, is this only true for the very, very, very best companies, or is this true for many companies? Or
first of all, I think it's only true for the very best companies. Most companies that in my portfolio that have gone public or down on their IPO price, especially post-lockup, even for years afterwards. So it's only true, the compounders are really only the Facebooks and Googles and Shopify of the world. There are not very many of these. The companies with less than 10 billion market cap, most of them I think are down massively from their IPO price. So that's problem number one. Problem number two, the statement of most of the value accrues afterwards is in terms of absolute dollars of capital, not in terms of IRR. And so if you're deploying 10 billion or 15 billion, that's fantastic. It can compound at 15% a year, and it's a lot of money. I'm capital constrained today. And so I still have many opportunities to deploy at 40% IRR in the early stage. And so the minute a company goes public, I typically, I'm locked up for 6 months. I mean, once the lockup expires, we're going to sell 100%. We're not public market investors, and even if we were, we're not going to be getting 40% IRR. So I'm redeploying the capital early every single time because there's more opportunity early stage. Again, it's a different problem if you're an asset manager with $100 billion. You're not going to be able to get these 40% IRRs, and you're not going to be able to deploy that type of money early stage. So then, of course, you stay in the companies that go public that can keep scaling forever. In my case, I'm way better off reinvesting in C today.
Super interesting. I love your perspective here, and think a lot of people can learn something out of this dynamic, obviously. And at the same time, I know you have a love for the macroeconomics, and a lot of opinions, and a lot of them were right in the past. So I think one of the questions I'd like to ask is, what do you currently see in the macroeconomics for the next months, and what does this mean for the venture ecosystem?
So it looks like we pulled a cat out of a hat, or kind of a miracle. So in the last 70 years, we've only had one example of soft landing, which is 94. And every other time when we had yield curve inversion and kind of a banking implosion with a flight to safety where the assets were being pulled out of the banks and put into T-bills when rates went up, or rates went up as fast as they have, we've had a recession. And so the consensus in 22, 23 was we were going to get a recession, and it turns out that the U.S. consumer, despite being over-levered, has actually been doing really well. The unemployment is at record lows. Net income, real income is at record highs. The low inequality has been declining. The blue-collar workers and the middle class have been doing better than the upper classes. And so the economy has been a lot stronger than people expected in the U.S. And that's why, by the way, rates have remained longer than people have expected. And so where I look at where we are in the cycle, it looks like we're at either soft landing or a no landing, which is, go sideways. And current expectation is a bunch of maybe 1 or 2 rate cuts this year. Not the 4 or 5 people were expecting, because inflation is hotter than people would like. Unless there's a geopolitical accident. So current expectation is continued growth. Productivity growth seems to be picking up, possibly because the AI revolution is starting to seep into underlying productivity stats. And as rates start becoming cut and people become long risk, the IPO window should open again. And so I'm hoping that in 25 and 26, we see a number of IPOs from amazing top-tier companies. And I look at my portfolio, and there are amazing companies like Vinted, et cetera, that are in a position to go public in 25 or 26, and that I hope will go public in 25 and 26. And that will be amazing for the venture ecosystem writ large. Now, that's not to say there are no risks. The number one risk, of course, right now is geopolitical. Could there be larger confrontations at a global level or in the Middle East? Absolutely. And that would actually lead to a massive change in both macroeconomic and macroeconomic dynamics. There's a level of risk associated with the U.S. elections. TBD what ends up happening from a policy perspective, if there's a regime change or not, unclear, and in terms of unrest. So there's, I'd say, geopolitical writ large overhangs or risks, but other than that, things look rosier than I would have expected them to be, by the way. I was more bearish in the past, but right now it looks like the IPO window will reopen in 25, 26, and we will have a lot of long-standing, successful companies going public. And the Shippa, Vinted, maybe Slice, in the larger end, I can imagine Stripe, perhaps SpaceX at some point will want to go public. So all these companies that are doing really well will want to go public, and companies that I don't know how well they're doing, like Flexport, but probably still very valuable, may want to go public as well. So I think there's going to be an opening, and it'll trickle down. As these companies go public, the LPs start getting liquidity, and they can reinvest in the GPs and the funds, and then that leads to more investments in the ecosystem at large. So I'm hoping it plays out this way, understanding that we are at a reasonably high level of geopolitical uncertainty.
So until, for example, the IPO window reopens, also in the earlier stages, we still have to wait?
Well, that's not my recommendation. My recommendation is invest now, because right now it's less competitive, valuations are more reasonable, founders are focused on burn and unit economics. The issue is many GPs don't have capital because they didn't raise a lot of capital, or they don't have enough capital, and they're being cautious. So that's not my recommendation. My recommendation is 23, 24, 25 is going to be an amazing moment to invest in early stage. I'm just saying the venture ecosystem writ large will be in a healthier level in the future once the IPO windows reopen and LPs start getting liquidity, because in 23 there were 5x more capital calls than there were outflows. So I think in terms of distribution, so I think it was like 80%, 20%, something like that.
So what's your recommendation for founders that are in pre-seed to Series A right now, like the earlier stages when they need to fundraise in the next months?
Well, if you have the money, when you need to fundraise, go fundraise. It's the macro is exogenous to you. Just set the terms that are going to clear the market and make it happen. Just don't be too greedy. It's more important to have capital. Ideally, have capital for 2 years. This way, when you go back to market in 26, you'll be in a much stronger position to command better terms. So at least raise for 18 months for sure, but ideally 24 months, and focus on burn, unit economics, and get to the scale. So what a lot of our companies have been doing is, if they were seed and they're going for an A, but their metrics are not what the current A investors expect, as I said, $750K in GMV, 100K in net revenues, or if you're a B2B SaaS company, like 100K in MRR, 1.2 million run rate in ARR. If you're not there, and that's on the low end, by the way, if you're not there, do a seed extension. Go to your insiders and say, hey, I need $1 million more, and maybe flat to the last round. It doesn't matter. Survive, get to your point where you can raise your next round, have 2 years of cash, and don't be too greedy on valuation, etc., because the market is not that easy right now, except in AI.
Yeah, except in AI. Fair enough. Even there, it feels like we see a little calm down, but only sometimes, depending on the business.
Yeah, I think we might be past the top of the hype cycle, but we'll see.
Besides investing, I think we talked a lot about your professional life now, and in the beginning a little about how you structure your life and what makes you happy. And I think it came out that you're also very sports fanatic, and I think we didn't mention as much how extreme sports affine and fanatic you sometimes are. What would you say are the biggest parallels between investing, building companies, and extreme sports?
So the parallel is, by taking a little bit more risk than most people, you could be highly rewarded for it. Now, the reward system is different. In tech, you take a bit more risk than most people because you're willing to go bankrupt, and therefore it doesn't matter. I mean, the reality is, like, what's the worst that can happen if I go bankrupt? I'm going to go and stay with friends on their couches or live with my parents. Who cares, right? Like, I'm going to get a job. I'm not going to be under in the streets. And so people are overly worried about the downside. And if you went to a good school, you have reasonable friends and parents, you're going to land on your feet. You're going to be fine. You're going to find a job. You're not going to be on the streets. And so people, I think, are more risk-averse than they should be. And you're financially rewarded for taking a risk in the tech sector as a founder, as an investor. In extreme sports, the reward is more flow states. If you are at the limit, I think your mind focuses, it sharpens, and you enter a beautiful flow state of Zen, that I think is enjoyable in its own right. And by the way, the activity itself is enjoyable in its own right. So I love heli skiing. I love going in crazy adventure travel. I walked to the South Pole. I crossed Costa Rica on bicycle with my backpack and tent and water filtration system from the Atlantic to the Pacific. I mean, doing these types of adventures, I absolutely love. And I'm taking maybe marginally more risks than some, but again, not that many because we try to control it, right? Like if I'm going extreme skiing, I do avalanche training. I have a beacon. I have a probe. I have a shovel, and we have a radio, and we kind of know the snow conditions and when it's risky and when it's not risky, and we take controlled risk basically. And once you have mastery of something, it's easier to get into a flow state, and so it's similar, by the outcomes, the purpose, what we're trying to get out of it are different. You take a little bit more risk, and the reward in one case is financial, the other case is you're rewarded by beautiful, wonderful experiences and flow states.
What's your formula to evaluate if taking the risk is worth it?
I think it's almost always worth it because I think most often the risks in life are very, very, very low. But look, if something had a 5% probability of dying, I wouldn't do it. But if it's 0.01% and the reward is huge, yeah, why not? Even though I might want to do it 1,000 times in my life, that's fine.
Fair enough. And what are things you learned about yourself throughout your extreme adventures?
I think many of the things I learned about myself are probably universal. That I can push myself a lot more than I think I can. And so whatever you think your limit is way further than that. You can suffer more, you can take more. So if you go to the gym, you can push yourself more than you think you can, as an example. But in the Antarctica trip, for instance, it was like negative 50 with wind chill. I'm pulling a 100-pound sled. We're walking 8 hours a day in horrible conditions. So you're exhausted. If you have to do it, you can do it. And so number one, I think, is you are more resilient than you think you are. Number two, a lot of this turns into a big gratitude practice because you realize, you're a privilege to be doing this experience, but then you come back to the world and you realize how privileged we are. I mean, I come home and there's like hot water and a toilet and electricity, and I can order food and get a pizza. I mean, these are like crazy luxuries. And when you go back to living the way people lived hundreds of years ago, it was hard. You're spending all your entire time to survive. Like, survival is a full-time job. And now we live in very privileged lives. Even if you're in the middle class or lower class in the West, your life is privileged relative to that of people 200 years ago. And I think we don't realize that, and we take it for granted. And so I think these adventures are an amazing experience and gratitude practice, basically. And so you're grateful for the opportunity to be there, for the lesson you learned there, for the fact that people support you to be there. So it's amazing.
How do you approach like physically or mentally hard times? Because you had the physically hard times walking to the South Pole. You had a company that wasn't making money for a while, and you didn't get money from investors, and you had to go through that time. So you have mentally and physically hard times from like decades that you can look back to. How do you assess such times?
Yeah, honestly, look, it never bothered me because I never saw the downside, where like my first company essentially went bankrupt, or I lost everything, didn't make any money out of it. Big deal. I didn't do this for the money. I did this because I liked the 0 to 1. I liked building something out of nothing. And so I was like, okay, I'm going to build my next company, even though the internet is going to be a small thing. It's not going to make money. It doesn't matter. I like it. And the next company, while I was building it, the day-to-day was hard because we can raise money from investors. I have to live in New York and like sleeping in the couch at the office and taking showers in the office. I couldn't even afford coffee, and I could only eat ramen noodles because it's the only thing I could afford. But I never saw it as a big deal. I was like, yeah, maybe it's going to fail. Most likely it's going to fail. By the way, the 5-year survival rate of a startup is 5%. It's okay. I mean, do your best for it to succeed, work hard, but I don't know. I'm built happy and optimistic and and grateful. And so it never none of these things are like, I realized at the end of the world, right? Like in Maslow's hierarchy of needs, my fundamental needs were met and everything else is, gravy. And so never, none of these things, as I said, we're more resilient than we think we are. And it's a question of your attitude. And in general, I'm grateful and happy and optimistic. And, there's a saying, which is the mind is the only organ that can turn heaven into hell and hell into heaven. So even though you could be in suffering, etc., as long as you tell yourself, like, this is amazing and you're doing what you're meant to be doing, it's a good experience. And so you can really have the experience. You can really lead and live the life you want to live. You can basically frame everything that's happening to you in a way that is positive. And I totally believe delusion is positive.
It feels like by living a very stoic life, you reached a lot of the things that others would fight for and suffer for all the time and try to make it happen somehow. With, I would say, even like, crippling for it. And it feels like it's even when there were hard times, it feels like by living the stoic life, it somehow felt easy to get there for you.
No, look, it's never easy. It's a lot of hard work, but it's a question of like what you love doing, right? Like, you love what you do and you never work a day again in your life. And so as long as you love what you're doing, it doesn't matter that it's hard. It's totally fine. And so that's why I think people, if you do things for the wrong motivation, if you do things because you want to make money or whatever, at some point, if you don't love what you're doing, you're going to be burnt out and it's just not going to be worth it for you anymore. And so, yes, not having these needs and just being grateful, et cetera, is extraordinarily helpful. But that said, I wouldn't take the stoic thing to its natural extreme because I love enjoying life. I love having an amazing life as well. I take pleasure in the things that, that are simple and that are in front of you and focus on the experiences you can get.
Do you ever feel the need of or for external validation?
No, not really. I had the opposite problem as a kid. I thought I was amazing, so I thought I was a narcissist. I was probably a narcissist. I was like Sheldon Cooper in The Big Bang Theory until my mid-20s. Like in college, and I was like, I'm the shit, right? Like I know everything, I'm amazing, etc. So I never had a need for external validation because I thought I was the best at everything. What's interesting is the more experience you have, and the more you realize how little you know, like nothing, Jon Snow, and Ingrid is right. The life teaches you humility. I was very arrogant as a kid because I was very smart and very successful at everything I did, and then as you get your teeth kicked in a few times and you realize how little you know, you become way more humble. I don't come across as humble, by the way, to begin with, but relative to where I started 20, 30 years ago, way, way, way more humble. And so from that perspective, you need to realize how little you know and just be grateful for the things you have.
It's interesting because I, as a kid, also like high IQ, whatever, felt very easy in school. But at some point, it felt for me like, okay, I was too much for a lot of other people, so that I developed into a way of being a bit more defensive about my thoughts because I know, okay, sometimes it's hard for others to keep up with. And like I became more like, I put myself a bit more into a cocoon and like became more defensive. And therefore, it feels like I think you probably know people that went that way as well, because I think there are two things: either you stay in your lane, or you take the other lane. You just become a bit more calm, try to hold back with some of the thoughts that you have, and it's interesting to see where the other lane is on that path.
Yeah. So I was in the other camp, meaning I was like, I thought I did my own thing, and I'm like, everyone else is an idiot and they can do their own thing. I know they're wrong, right? Like, so I was like I had no need for external validation because I'm like, I know I'm right. And now here's what's interesting. is I wasn't necessarily right. I was right for me, right? Like, so I decided to build the life that's right for me, and it's not actually right for everyone else. And so one of the wisdom you get as you get older is you realize, my value, the reason I judge people through the lens of IQ is I'm very smart. Therefore, everyone else who's not as smart is deemed less valuable. Because as a kid, that you want to have value, but I didn't need it from external persons or parties. I just brought it to myself. Today, I think there are many different types of perspectives and values in the world, and the choices I make are relevant and reflective for me. So I lead the life I want to lead without the care for what others think, because it's not their life to lead. It's my life to lead. I do think most people should actually lead a more authentic life that is better for them, and not be afraid of what other people think, because the reality is most people don't think of you anyway. They're too lost into their own thoughts, and it's irrelevant. And there's no societal, who just said that you have to, whatever, go to college and get a job and get married and have 2 kids and a dog or whatever. I mean, like, these are societal norms, but where do they, I mean, I can tell you where they come from, but it's kind of like an accident of history. It's like when wheat was domesticated, or we domesticated us, and because all of a sudden the output of your work became, what was the amount of work you put in, it led to the introduction of property rights, which led to women and children becoming property, and children as well. And so you started having an agricultural society, which led to a patriarchal society, which led to religion enforcing it, et cetera. So I can explain to you the history of why we ended up with the system we have today and what are the norms. But when you think through, do they make any sense in the world we live today? The answer is not particularly. And so you should actually live a life that's authentic to yourself. And most people are not comfortable doing that because they value they think they care about what other people think. And that, in a way, maybe that's a privilege. I never cared. It's like, I do my own thing. You may hate me, you may love me, irrelevant. Yeah, as long as it's right for me, that's what matters. But again, I've come to realize over time how rare that way of thinking is, and how privileged I am to always see the optimistic outcome and things, and to be grateful for everything I have. Like, I feel gratitude at all times for everything, and I realize that most people don't feel that.
Yeah, I think that's something you realize when you talk to a lot of people, that like a lot of them are or feel like they have to live in the constraints of others and be successful in the thought of others and what others would do in their perspective. I always think the hardest part sometimes is to ask yourself, not like, what should I do? Because often you involve, okay, what would others do when they were in my position? So it's really, what do I really want to do, no matter what others think? And it's not that easy with for a lot of people. I am definitely not for everybody, but for a lot of people.
I agree. Yeah, I mean, look, the fact that I started in such a outcast type of way of thinking, the Sheldon Coopery type approach, it was easier in a way, because then I'm like, okay, I'll do my own thing. And it's okay. When I left McKinsey when I was 23 to go and build a startup, my parents are like, are you crazy? You have like the perfect job, and you've never failed at anything in your life, and now you're creating something you're going to fail, and it's going to crush you. And I'm like, yeah, but I'm going to be happy, and it's funny because like a year later, when I was very successful, at least on paper and on TV, they're like, yeah, we always encourage our son to be a tech founder. And then 2 years later, I went bankrupt, and they're like, we told you so. You should have stayed at McKinsey. I'm like, I do what's right for me. Doesn't matter.
What would you say makes a great decision in personal life, but also in running a company?
Don't take yourself too seriously. Have strong convictions loosely held so you can be swayed by data, and just iterate. In life, I find, in personal life, for sure, people don't iterate enough. They don't try enough things to see what's right for them. In startups, people do try. They try different business models, they try different designs, different approaches, etc. In personal life, they definitely don't try enough things. And, what is the right relationship structure for you? What is the right living structure? Like, should you be living all times in one city versus multiple cities? Should you be nomad? Should you not be? Should you be in an open or closed relationship? There are a whole bunch of things that people don't test. They just go where the default norm is. Should you even get married? Should you have kids? It's not for everyone. It's amazing. I highly recommend it, but I don't think there's a normative way that says this is the answer for you. You need to figure out what the answer is for you. Now, of course, you can't have kids and then return them. So that one is different. But I think people need to experiment more. Whatever, do ayahuasca. Go and find a spiritual side to your journey. I mean, there's a lot of things I would recommend people try and do in life that they typically don't.
Honestly, I think that's a perfect ending to our conversation because it lets people think about themselves right now with new input diluting the effect of your words, I think.
Perfect. Wonderful.
Fabrice, it's been such a pleasure. Of course, I'll link to FJ Labs for everybody who thinks, okay, I'm building a marketplace or network effects business and want to talk to these people because it seems like they could be a good fit for me. And I link to your LinkedIn, to your blog, to everything because you have a lot of great resources, articles, thoughts. It's been such a pleasure. Happy to hand over the last words of our podcast.
Perfect. Thank you. Take care.